Welcome to Ben's Market Insights. We've been off for a few weeks over the summer, so welcome back to everyone. Hopefully you've all had a great break and a relaxing break at that. We thought we'd start this week with a little bit of a wrap on what we think has been happening and what's going to drive markets going into the autumn and towards year end. From an economic perspective, I think a lot of things are pretty much as they were before. I don't believe that we're going to see a rate rise before year end, although there's quite a lot of market pressure for that to happen. The 10-year yields keep pushing higher. Inflationary pressure hasn't really shown any further acceleration, but we're potentially likely to see that as we go into the next 2 to 3 months, and that would put even more pressure on the Fed to raise rates, which would be certainly negative for stock market activity. But so far, we've been seeing a relatively low level activity from the continuing Iran war. I continue to believe that I think it's going to be a nefarious sort of sidelong battle going on, nothing headlining, but certainly something that keeps the administration in the US on the back foot. And I think that implies that certainly the Iranians would like to see inflation remain under pressure in the US, putting the midterms in a bit of a risky scenario for the current administration. And so the pressure is upwards. There is no doubt about that. And I think that whilst interest rates stay stable, certainly the next move could well be up, but probably into next year. And by the way, if you're enjoying this content, please give us a thumbs up and a subscription onto our YouTube channel, Ben's Market Chat. Thank you very much. So on a micro view, we've had a lot of our results are all out pretty much, except for NVIDIA this week, which will certainly be a seminal comment on the AI trade. What we have seen is that the CapEx has continued growing unabated pretty much, taking on board not only next year's growth, which is implying further CapEx coming through, but also this year's CapEx, despite the fact that we're nearing year end, is accelerating still further. And that's partly to do with memory chip price inflation that's making these cost increases continue unabated. Is this good or bad? I'm trying to see sort of a balance here. Certainly when we look at what Alphabet told us, they are seeing a significant cloud revenue growth of some 82% year on year. All of the cloud providers have seen a re-acceleration in their growth, and we'll touch on those in a moment. They're seeing that their LLM and their Gemini, corporate enterprise level Gemini, is growing at a very fast pace. Their backlog in terms of their recognition of revenue over the next 2 years on a $514 billion contracted backlog, which has grown some 30% over the last quarter, which is phenomenal. They do have, nonetheless, now in a position of negative free cash flow of some 5.9 billion, which is why the markets are beginning to clearly get nervous. But we'll come back to valuations, and we think that the current levels are quite reasonable. When it comes to Amazon, AWS has re-accelerated once again for the last few quarters. It's been pretty impressive, and we're seeing a 37% year-on-year acceleration, which is the most we've seen in quite a number of years. Microsoft Azure also seeing a re-acceleration of some 43% year-on-year. All of them are seeing a substantial growth internally within that cloud facilitation of the AI growth in activity. And that is a very important part of creating that return on invested capital that we're all waiting for from this CapEx. And I think that certainly is beginning to come through. In Apple's case, obviously not a cloud provider, but has also seen clearly its equipment is being used as a tool to get at AI facilitation, if you like. And so their iPhone growth has seen a 22% growth, and that's an all-time high unit device growth now at 2.5 billion units owned by users. Meta didn't fare so well, but again, they saw a significant increase in their CapEx from 125 billion for this year only to now raising that guidance to 130 to 145 billion dollars. That's really based on those cost inflation elements that we talked about earlier. Ad revenue is still growing and is using that AI. So ad revenue's growth is at 27% year on year. But again, their cash flow has gone from 8 billion this time last year to 800 million this time around. So again, a concern that a lot of these companies are using up their free cash flow generation. But why not? If your return on invested capital is going to be significantly better than the average return that a fund manager can get on their assets on the stock market, I would be supportive of that. So let's see. So far, the early signs of the return on that CapEx is actually quite good in terms of usage of tokens, AI tokens being absorbed, of enterprises buying into the LLM platforms to customize for their own usage is proving to be positive. Now, when it comes to valuation, I think that the technology sector, which has lagged behind to some extent, I mean, if we look at it in very broad terms, certainly since June, we've seen the broad-based, which is the equal-weighted S&P index, is up some 4%. Compare that to about 1.5% for the S&P index, which clearly has a 30% weighting towards technology. So technology has been underperforming, but is that justified? Clearly, the big overhang is this CapEx spend. But if we start seeing some form of returns over the next 2 to 3 months in the next set of announcements, I think that creates a very interesting upside catalyst. So the S&P broad-based earnings growth for this year and next year is at 12% for this year, 11% for next year. For the S&P index unweighted, we're looking at something like 30% earnings growth this year and 14% in 27. Now, when we start thinking about PEs, forward PEs, the S&P equal weight is on some 21 times, 21 and a half times forward. Compare that to, or rather 20 times forward, compare that to 21 and a half times for the normal unweighted index. In other words, the growth in earnings is really being pushed through by the technology companies, and they are pretty much at the same valuation. So I would be very supportive of the continued or return to the MAG7 and return to technology per se. Semiconductors are down some 15% since June, probably justified because we are talking about a cyclical sector after all, whereas I think that the MAG7 has some very significant structural growth opportunities within them. Looking at the earnings of the individual stocks within the MAG7, and I X out Tesla to a large extent in this process because I think they are wildly overvalued. We can see that Alphabet is on a 15% earnings growth, 15 to 20% forward earnings growth on 18 times next year's earnings. I think that's very reasonable and showing some significant growth opportunities. Microsoft is on 20% earnings growth and a 27 times multiple, less reasonable, certainly premium to the market, but still nonetheless showing some positive attributes. Meta on 6% earnings growth, but on some 15 times earnings. They've got issues of their own in terms of the current court case that's going on in California, in terms of their social media platforms and how they're influencing youngsters. They've also got a significant concern, I think, in terms of their play within the cloud world. We'll talk about that potentially next week in terms of a lease versus own data centers, and maybe actually Meta has the right strategy within that. Amazon is on some 25% earnings growth. All of this is, by the way, in terms of consensus, and 23 times forward earnings. Again, very reasonable, certainly when you compare that to the likes of Walmart, which is clearly much more physical peer, and therefore is should be in fact cheaper, but Amazon is the cheaper play here. And probably the outlier within all of this is Apple with an 8% guidance in terms of earnings growth from the analyst base, but on 33 times forward earnings, probably a little bit too rich for us at this juncture. So Google, I think, or rather Alphabet in this respect, comes out as the most interesting in terms of growth versus their forward multiples. But overall, I would say that the technology sector is back in its slot as the growth accelerator for the market, and probably something for us to refocus on into the Q4 period. Have a fantastic week and see you next week.